Welcome back. This is Dr. Annette Moultrie, and we are continuing in Accounting 102. In this video, we will cover Chapter 10, which deals with plant assets, natural resources, and intangibles.
But before we proceed with the video, I need you to click on the subscribe button. Click on the thumbs up button below. Also, click on the notification bell so you'll be notified of upcoming videos.
This is part 4 of plant assets, natural resources, and intangibles. Part 4. In this video, we will discuss learning objectives 4, 5, 6, and 7. 4 deals with the account for natural resources. 5 is the account for intangible assets. 6, use the asset turnover ratio to evaluate business performance. And finally, 7, we're going to discuss journalize entries for the exchange of plant assets. So learning objective 10.4, account for natural resources. So what exactly are natural resources? A natural resource is an asset. It's an asset that comes from the earth and is consumed. Some examples of natural resources are natural gas, iron, gold, diamonds, coal, timber. Natural resources are expensed through depletion. What is it? Depletion. Depletion is the process by which businesses spread the allocation of a natural resource's cost to expense over its usage. It is called depletion because the company is depleting, or another word, using up a natural resource such that at some point in time, there will be nothing left to extract. Depletion is computed by the units of production method. Assume an oil well costs $700,000 and it is estimated to hold 70,000 barrels of oil. There is no residual value. If 3,000 barrels are extracted during the year, depletion is calculated as cost minus residual value, divided by estimated total units. So 700,000 minus 0 divided by 70,000 barrels is equal to $10 per barrel. Then you would multiply the depletion per barrel by the number of barrels for the period. So $10 per barrel times 3,000 barrels is equal to $30,000 of depletion in year 1. The depletion entry for the year debits depletion. It debits depletion expense and credits accumulated depreciation oil reserves for $30,000. Accumulated depreciation is a contra asset account. It is similar to accumulated depreciation. Natural resources can be reported on the balance sheet as the net of the natural resource asset account and the accumulated depletion account. That was the end of learning objective 4. Now we're entering learning objective 10.5, which deals with account for intangible assets. So what are intangible assets? Intangible assets are assets that have no physical form. Some examples of intangible assets include patents, copyrights, trademarks, and other creative works. So the final group of long-lived asset is called intangible assets. In our technology-driven economy, intangibles are very important. The intellectual property of a business is difficult to measure. Intangibles can account for most of a company's market value, so companies must value their intangibles just as they value other assets, such as merchandise inventory and equipment. Intangible assets that are purchased are recorded at cost. Now, if an intangible is not purchased, only some limited costs can be capitalized. Most purchased intangibles are expensed through amortization. And amortization is nothing but the process by which businesses spread the allocation of an intangible asset's cost over its useful life. So only intangibles with a definite life are amortized. Now, intangibles either have a definitive life or an indefinite life. Intangibles with an indefinite life have factors. They have factors such as legal and contractual obligations that limit the usage of the intangible asset. Only intangibles that have a definite or definitive life are amortized. Intangible assets with an indefinite life are tested for impairment annually. An impairment is a permanent decline in an asset value. Impairment occurs when the fair value of an asset is less than the book value. So in other words, there has been a permanent decline in the value of the asset. So if an impairment occurs, the company records a loss in the period during which the decline is identified. A patent. A patent is an intangible asset. It is an intangible asset that is a federal government grant conveying an exclusive 20-year right to produce and sell a process, a product, or formula. The acquisition cost of a patent is debited to the patent account. Suppose Smart Touch Learning pays $200,000 to acquire a patent on January 1st. The entry to record the acquisition would include a debit to patent for $200,000 and a credit to cash for $200,000. Now, suppose Smart Touch Learning pays $200,000 to acquire a patent on January 1st. The amortization expense is calculated using the straight line method. So the cost, $200,000, is divided by the life of 5 years equals an annual amortization expense of $40,000 per year. As is true in this example, most intangibles, no residual value. Here, notice that Smart Touch Learning credited the amortization directly to the intangible asset patent instead of using an accumulative amortization account. A company may credit an intangible asset directly when recording amortization expense, or it may use the account accumulated amortization. Companies frequently choose to credit the asset account directly because the residual value is generally zero, and there is no physical asset to dispose of at the end of its useful life. So the asset essentially removes itself from the books through the process of amortization. So here at the end of the first year, Smart Touch Learning will report this patent at $160,000. That's $200,000 cost minus the first year amortization of $40,000. So the next year, it would be $120,000 and so forth and so on. So each year for 5 years, the value of the patent will be reduced until the end of its 5-year life, at which point its book value will be zero. A copyright. A copyright is the exclusive right to reproduce and sell a book, a musical composition, a film, another work of art, or intellectual property. Copyrights also protect computer software programs such as Microsoft Windows. Issued by the federal government, a copyright is granted for the life of the creator plus 70 years. What is a trademark? Trademark or trade name is an asset that represents distinctive identifications of products or services such as Nike, Swish, or the McDonald's Golden Arches. Legally protected slogans include Chevrolet, Like a Rock, and De Beers. A diamond is forever. These are all examples of trademarks. The cost of a trademark or a trade name is amortized over its useful life. Franchises and licenses. Franchises are privileges granted by a business to sell goods or services under specified conditions. The Dallas Cowboys football organization is a franchise. It's a franchise granted by the National Football League. McDonald's and Subway are all well-known franchises. My favorite is Chick-fil-A. A license is a privilege granted by a government to use public property in performing services. A radio station may be granted permission by the federal government to use the airwaves to broadcast music. The acquisition of a franchise or license is amortized over its useful life. Goodwill. In accounting, goodwill is the excess of the cost of an acquired company over the sum of the market value of its net asset. That is, assets minus liabilities. Goodwill is the value paid above the net worth of the company's assets and liabilities. Goodwill is recorded only by an acquiring company when it purchases another company and pays more for that company than the market value of the net assets acquired. An outstanding reputation may create goodwill, but that company never records goodwill for its own business. So according to GAAP, goodwill is not amortized. Instead, the acquiring company measures the fair value of its acquired goodwill each year. Here in this example, White paid $2 million above the market value of Mocha's net assets. Therefore, that $2 million is considered goodwill. You can see the purchase price to acquire was $10 million. The market value was $9 million. So the market value of Mocha's liability is $1 million. S market value of Mocha's net asset, $8,000. 9 minus 1 is $8,000. So the goodwill is $2 million. So white entry to record the purchase of Mocha creates goodwill with a debit of $2 million. So asset is debited for 9, goodwill is debited for 2, liabilities is credited for 1, and cash is $10,000 credit. So how do we report intangible assets? Here in this exhibit, 1011, it summarizes the types of assets and their related expense. Plant assets are those that have physical characteristics and are used in operations. Natural resources are assets that come from the earth and can be ultimately used up. Intangible assets are assets whose value is not derived from their physical substance. So with plant assets, the related expenses, depreciation, natural resources is depletion, and intangible assets, amortization. And here we go into learning objective 10.6, which deals with the use of the asset turnover ratio to evaluate business performance. So how do we use the asset turnover ratio to evaluate business performance? The asset turnover ratio measures how efficiently a business uses its average total assets to generate sales. So asset turnover ratio is equal to net sales divided by average total assets. Average total assets is equal to beginning of a period total assets plus end of period total assets divided by 2. Now, using net sales revenue and total assets in millions from Kohl's Corporation in 2018, from their annual report for the fiscal year ending February 2nd, 2019, suppose that the asset turnover ratio for the industry is 1.9 times. Now, Kohl's asset turnover ratio is 1.48 times. That is significantly lower than the industry's average. Now, this tells us that Kohl's is only producing $1.48 of net sales revenue for each dollar of assets invested. The average industry is 1.9. Okay, it's 1.9. So Kohl's is 1.48. So Kohl's is producing $1.48 of net sales revenue for each $1 of assets invested, while the average company in that type of industry is producing $1.90 in net sales revenue for every dollar invested in assets. So Kohl's should evaluate ways to improve its efficiency and also increase its asset turnover ratio, such as increasing net sales revenue or decreasing average total assets. Here we are in learning objective 10.7. This is the last one. Journalize entries for the exchange of plant assets. So how are exchanges of plant assets accounted for? Now, sometimes plant assets are not simply sold or purchased, but instead a plant asset is exchanged for another plant asset. An exchange has commercial substance if the future cash flows change as a result of the transaction. Commercial substance is a characteristic of a transaction that causes a change in future cash flows. In other words, an exchange has commercial substance if in the future cash flows, meaning the receipts of revenue or payment of expenses of the business, will change because of the exchange. For example, exchanging an older asset for a new asset that will increase productivity. So it will create more revenues for the business. Here in this example, on December 31st, Smart Touch Learning exchanges $2,000 cash plus used equipment with a historical cost of $10,000 and accumulated depreciation of $9,000 for new equipment. The new equipment has a market value of $8,000. The exchange has commercial substance. There is a $5,000 gain on this transaction, $5,000. The journal entry removes the old equipment and its accumulated depreciation. It records the new equipment and the payment of cash, and it also recognizes the gain on disposal. Here you see the debit to equipment, debit to accumulated depreciation equipment, credit to equipment, the old equipment, $2,000 credit for the cash, and the gain is $5,000 credit. On December 31st, Smart Touch Learning exchanges $2,500 cash plus used equipment with a historical cost of $10,000 and accumulated depreciation of $9,000 for new equipment. The new equipment has a market value of $3,000. The exchange has commercial substance. There is a loss of $500 on this transaction. The journal entry removes the old equipment and its accumulated depreciation. It records the new equipment and payment of cash, and it recognizes the loss on disposables. This is the end of this series on plant assets, natural resources, and intangibles. Stay tuned for the next chapter. Thank you.
Thank you for watching. And please, if